It's a bit of an obscure graph here, but let me try to explain. So the vertical line is, and the horizontal line is the time for which you're invested. So it assumes a single investment up front, and you look at what your variability returns are over time. And the outside lines represent the 50-50 equity portfolio. And you will see that the expected returns, the bar line in the middle, they're so close on this graph, you can't tell them apart. But starting at the first year, very high variability. So for 100% equity, the top 1% of years, you'll make 50% or more. And in the bottom 1% of years, you're going to lose 30% or more. So huge variation in outcome. So if you're investing for a year, that's not an appropriate investment. Our diversified portfolio, you lose a little bit on the top end. You give up a bit of return, but you pick it up on the bottom end. And over time, as you get more and more years in the mix, you tend to close the gap around the expected return. The expected return being the median return, the 50%. And so in this case, you end up with, after 20 years, with relatively narrow ranges of returns, although in dollar terms, they can be very significant. But the range of outcomes for our diversified portfolio is narrower, and the bottom return is higher. You do give up some on the upside, on the extreme upsides, but when you're looking at most goals, a massive outperformance of your expected return doesn't really help you in advance, and it certainly doesn't help you when you're looking at withdrawing a retirement income stream. So the fact that the red line, being the lowest percentage of the growth portfolio, is below the shaded teal area means that my safe withdrawal rate will be lower for that portfolio. So moving along, that then flows into the probability of achieving my goal. So if we take this investor who's going to invest $100,000 on day one and has a goal to have $387,000 by year 20. And to do that means they need to realize a 7% annualized return over 20 years. And they have a choice of investing in 100% equities return, which does have a higher upside, or in a lower volatility, slightly lower return portfolio. And so what you see is in the early years, because of that potential for massive outperformance, there are very few periods in which it occurs, but there is a probability that you might achieve your goal very early on. Very low probability. So there's a 20% probability with our equities portfolio that we could get to our $387,000 within a decade, massively outperforming our goal, and everyone's happy. But that's a very small probability. When we start looking at probabilities that are more like ones that you'd be comfortable with, the 50-50 probability, not dissimilar. But when you're looking for higher probabilities of achieving your goal, our diversified portfolio delivers us 99.9% probability of getting there by year 20. That's only about 85 to 90% for our equities portfolio. So you really can't look at expected returns in isolation. The longer the period you're looking for, the more volatility you can accept. But you've got to align the asset allocation, the expected returns, and the volatility to your goal and your horizon. So if you actually needed a 10% return to achieve this goal, you would miss your goal half the time on either of those portfolios. And that's not a good look.